We had an 11 sigma event around housing stops today, or housing starts today. This is a very weird environment to be operating in, because one set of data will say one thing and one set of data will say the other. And I think the basic situation of this market has just been the very basic construct that the path of least resistance for the market is upward. Beginning home construction increased by 21.7% to a 1.63 million annualized number. It was the biggest number on record, a 291,000 increase in starts, the biggest percentage gain since October 2016. It's in every region of the country. Multifamily starts were up 30%. Permits were more subdued. But in an environment, even in the face of rising interest rates, home builders are building. And the question is, are they building these homes right now in the anticipation that interest rates are going to decline next year, and as a result, there will be a more attractive mortgage rate environment for buyers? That's a big bet, particularly when you look at the current status of what Powell is talking about. The bigger news will come on Thursday. That is when he will testify before the Senate. And that is where you're going to get a lot more pushback against policy. It's particularly going to come from Elizabeth Warren, who you obviously know has a lot of skin in the game. A lot of questions are going to be built around recession. If you hear that term, you're going to likely see some level of market move as a result. You're saying houses are being built for rental. I think that is a relatively good hypothesis, particularly for the multifamily housing. So with the multifamily housing, as you look at where this stuff is going to be financed, the one company that we were talking about that just continues to justify investment right now is in RWT, and that's Redwood Trust. So a relatively sizable dividend, built their investor presentation around the very simple idea when it comes to mortgage-backed securities and a lot of the financing that's going to be involved in multifamily housing. They're probably going to be the only game in town. So this is a long-term reversal buy. It's currently trading for about, I want to say the book value's $680? Oh, freaking 55. So you're buying something that's worth $6.4 for a $9.50 dividend, extremely strong, currently at 9.8%. Definitely something that I like for the long term. And one of the things that you're going to want to do is when you start to look at some of these more alternative investments, and Redwood Trust being one of them, I want to reiterate this because it warrants that level of reexamination. This is Redwood Trust's review for Q1. I want to find the exact presentation, but this came out in April, and this is a company that operates pretty deeply in investing in properties, residential mortgage backs, and business back. 87% of this really kind of comes from mortgage banking activities, and the bulk of this is heavy in the multifamily housing space. With that said, if we break down and we look at their actual argument for why they are a rational and reasonable investment, they start talking about the disruptions at the regional banks. Now, a lot of people don't believe that the alternative space is going to be the primary investor, but when you listen to this thesis, it's very, very compelling. And the basic argument is that residential assets for the regional banks are not going to be as profound in the future, particularly in the multifamily space, as what will be possible for a company like Redwood moving forward. So if the regional banking space is struggling and they're trying to avoid lending and they're trying to avoid loans, they're going to likely, if we have any type of housing issues moving forward, they're going to likely exit this world. And within their portfolio and within their argument, they basically are just simply stating that they are very, very, very well prepared to get into this business and replace the regional banks and replace the work of Wells Fargo and replace the mortgage-backed security type of engagement that the Federal Reserve has played over the last couple of really 7 to 10 years. This is a relatively interesting investment. So I like this for the long term. It's not something that I'm going to necessarily add to our portfolio because I think we have a little bit of a different strategy, particularly that kind of 18 to 24 month reversion strategy that's built around strong F scores and strong and cheap Gram scores. This is a different type of animal. But moving forward, when I look at multifamily, this is the place that we really want to be focusing, rather than trying to focus on the builders themselves. The builders have been extraordinarily strong. Coming off the back of that Fed pivot back in October, you've seen virtually everybody make a 52-week high or at least come in that range. And there still seems to be a lot more upside for the companies like KB Homes, Meritage, Cavco. All of those names are intriguing for the builders. But when it comes to the financing and the nuts and bolts, and then really identifying where there's actual value in this market, particularly in a major potential pivot for broader funding within that sector, Redwood Trust